Welcome to this explainer. I am so thrilled you're here today because we're about to put on our forensic accounting hats and investigate an absolute roller coaster of a financial story. We're looking at the sudden, breathtaking valuation collapse of Jeena Sikho Lifecare Limited. This is a classic story of what happens when a sky-high market narrative violently collides with cold, hard operational reality. To really grasp the scale of this event, you just need to look at this single number, 19.99%. That's right. On June 1st, 2026, Jeena Sikho's equity shares plunged by exactly that amount, instantly locking into the lower circuit limit on both the NSE and the BSE. Let me be clear, this wasn't some gradual, slow bleed decline. No, it was an instantaneous, violent market correction. Which brings us to a crucial, central question. How does a high-growth healthcare stock lose all its buyers in a single second? Think about it. For the full fiscal year, this company posted a massive 71% year-on-year growth in consolidated revenue and a staggering 177% jump in net profit. On paper, it looked like an unstoppable engine. Yet, out of nowhere, it hit an absolute brick wall. Okay, let's dive into this, because what happened at exactly 12:45 p.m. that day was a terrifying phenomenon known as a no-bid scenario. Now, if you're not familiar, this is essentially a complete market microstructure failure. It means the buy orders didn't just shrink or dry up a bit, they dropped to absolute zero. Momentum-driven institutions and retail investors alike all rushed for the exit door at the exact same moment, completely trapping everyone inside. And when I say trapped, I literally mean it. Just look at this staggering imbalance. At that moment, there were 5,117,895 pending sell orders on the NSE against zero active buyers. Zero. It was a total evaporation of investor confidence, just a complete freeze. So what on earth spooked the market this badly? Well, to find out, we have to rewind and look at the numbers they released just 2 days prior. Section 1. The Autopsy Q4 Financials. The trigger for all this panic becomes pretty obvious when we look at these figures. Now, while the year-on-year numbers look fantastic, we all know the market is forward-looking, right? It focuses heavily on sequential, quarter-on-quarter momentum, and, well, that momentum broke. Operating revenue actually shrank by 2.76% from Q3 to Q4. But the real shocker, the absolute gut punch, is right there in the middle. EBITDA margins collapsed from 45% down to 36%. That is a massive 900 basis point sequential drop, which ended up dragging profit after taxes down by 32%. So why did margins implode so quickly? Well, management pointed to 3 main culprits. First up, higher provisioning requirements due to some recent labor code amendments. Second, they had a huge spike in non-cash charges from their new ESOS 2025 stock option scheme, which basically front-loaded a ton of expenses right onto the income statement. And third, they paid out some pretty hefty year-end performance bonuses for executives and clinical staff. Put it all together, and this cocktail completely destroyed the operational leverage they'd worked so hard to build up earlier in the year. Now, this creates a really fascinating divergence between illusion and reality. See, on an accrual accounting basis, they were showing a super robust 177% year-on-year net profit growth. But as we know, profits on paper don't pay the bills. If you actually looked closely at the cash flow statement, their free cash flow was literally collapsing. So yes, the business was growing, but it was suffocating under the immense weight of massive working capital accumulation. Just look at how much cash got trapped on the balance sheet between March 2023 and March 2026. Accounts receivable more than tripled to almost 70 crore rupees. It was taking them so much longer to actually collect their money, with debtor days jumping from 54 all the way up to 76 days. Meanwhile, their inventory shot up from 4.10 crore to over 20 crore rupees. That is a truly massive amount of cash just sitting there, completely locked up in unsold Ayurvedic medicines and wellness products.
Section 2. The Underlying Disease, Operations and Capital.
Operationally, Jeena Sikho has been scaling incredibly fast. We're talking over 120 clinics and about 1,530 beds. But here is the catch. Adding physical capacity faster than you can actually find patients to fill it, that's a very dangerous game. Their established facilities run beautifully at about 80% occupancy. But all these brand new beds, they drag the total average way down to just 58%. And since new beds still require staffing and all those fixed overheads, this occupancy dilution acted as a major drag on their overall profitability. Now, what's really interesting here is how they tried to fix their cash collection issues. Notice that tiny 3.66% sliver for government panel sales? Historically, government contracts provided a really steady volume of patients. But because the government was notoriously slow to pay and pretty difficult to bill, management intentionally exited those contracts to focus heavily on private insurance and out-of-pocket patients. Honestly, it was a smart move for gross margins, but leaving those government contracts behind temporarily left a whole lot of their newly built hospital beds just sitting empty.
And here's where it gets even more complicated. At the exact time domestic operations were desperately starving for cash, management was diverting funds elsewhere. They pumped over 42 crore rupees into diagnostic partner warrants. Then, they sent a 7.53 million dirham loan overseas to a UAE subsidiary for an acquisition. To plug this sudden liquidity drain, they actually had to quickly sell off an idle plot of land in Punjab for 24 crore rupees just to shore up their cash position. It was like capital was flying in absolutely every direction except where it was needed most.
Section 3. The complications, legal and regulatory risks. Over the past year, the bad news just kept piling up, effectively shattering the brand trust that an Ayurvedic healthcare provider absolutely relies on. I mean, just look at this timeline. In April 2025, they were fighting an income tax reassessment notice. Then in August, local authorities actually sealed their Bhopal hospital over permit issues and illegal advertising. And by October, they were hit with a 5.08 crore rupee CGST penalty for historical tax violations. That Bhopal hospital incident is particularly concerning, mainly because of this quote right here. Authorities noted that the company claimed on radio and digital media to, and I quote, cure terminal illnesses such as cancer and organ failure, running counter to the Drugs and Magic Remedies Act. You know, for an alternative medicine company without patent-protected therapies, making unsubstantiated claims that invite severe regulatory crackdowns, well, that is a massive existential risk to their entire brand equity. Section 4. Technical alignment and market reality. So what does this all mean for the stock? Well, it was caught in a classic valuation trap. It was essentially priced for absolute perfection, trading at an astronomical price-to-earnings ratio of nearly 43 and a price-to-book of over 21. When you're priced that high, you simply cannot afford a single sequential earnings mess. And the smart money? They saw it coming. Foreign portfolio investors had already started quietly reducing their holdings. Once the stock slipped below its moving averages, a bearish crossover triggered automated trading algorithms. The algos started selling, retail investors panicked, and boom, you get that 20% limit lockout we talked about at the very beginning of this explainer. But what's really wild to me is the huge disconnect that still exists out there. The sole institutional research analyst covering the stock has actually maintained a massive 1,200 rupee target price. But to even get to that number, their model assumes an uninterrupted 54% annualized growth rate all the way through 2027. It's completely ignoring the massive margin compression and all those severe cash flow headwinds we've just uncovered together. Section 5. The prescription, path to recovery. So the crucial point here is that management definitely has a steep hill to climb. But the roadmap to get there is pretty clear. Number 1, they absolutely must optimize their working capital and collect the cash tied up in those 76 debtor days. 2, they need to stabilize those sinking EBITDA margins and absorb the new labor and ESOP costs. 3, they've got to get patients into those empty beds and boost that 58% utilization rate. 4, strictly comply with advertising laws to avoid having any more hospitals sealed up. And finally, number 5, they must show severe capital allocation discipline. That means no more risky international loans until the core domestic business is happily generating free cash flow once again. All of which leaves us with one final, very provocative question. Can Jeena Sikho Lifecare Limited actually align its messy operational reality with its shiny high-growth narrative? The market is watching incredibly closely right now. And I bet so are you. Thank you so much for joining me today on this explainer. Keep learning, stay curious, and I will see you next time.